Okay, let's dive into this. What if a single speech could literally give you a massive head start on understanding India's economic direction for the next decade? You know, recently, the Prime Minister's 2026 Independence Day address laid out a highly detailed economic roadmap. Now, looking at this strictly, neutrally as an economic policy blueprint, it outlines some massive 5 to 10-year growth themes. We're talking manufacturing, semiconductors, AI, and defense. It's an incredibly powerful vision of infrastructure and industrial growth. But here's the real puzzle. How does all that translate to the actual stock market?
And that brings us to the most crucial question we can ask today. Out of thousands of companies, which stocks could actually benefit from these 2026 growth themes? Well, in this explainer, we're going to impartially evaluate 15 specific stocks. We'll rank them based on their growth potential, valuation risks, and long-term upside. And ultimately, we are going to use all this analysis to build a hypothetical 10 lakh rupee thematic portfolio. Now, quick pause. Please remember, this explainer is strictly for educational and informational purposes. It is absolutely not investment advice, so always do your own research. But hey, if you're ready to learn how to analyze a massive macroeconomic theme, you are absolutely in the right place.
So here's our game plan for the analysis today. We're going to start big with the 2026 economic ecosystems and then filter our 15 stocks through a funnel of 3 different tiers: core compounders, high-growth plays, and higher-risk picks. After that, we'll actually build out that thematic portfolio, and finally, we'll wrap up with one absolutely massive final takeaway.
All right, moving into our first section. Now, what's really interesting about this is that the biggest takeaway from the speech isn't a single company. No, it's about massive, interconnected economic chains. Let's trace this first powerful investment chain together. Think about it, an initial massive push in semiconductors and electronics. Well, that naturally feeds right into the artificial intelligence boom. But AI requires data centers, big ones. And what do those data centers literally guzzle? A colossal amount of electricity. So that means India's growing tech economy creates this massive, inevitable demand all the way down the line for power generation and power infrastructure. It's like dominoes. One theme feeds directly into the next. And this brilliantly illustrates our second major ecosystem, which is defense. The government's policy push for defense indigenization starts at home, right? You've got drones, counter-drone systems, and missiles. But modern warfare requires incredibly advanced defense electronics, which in turn pushes the entire aerospace sector forward. Ultimately, this whole chain of indigenous capability ripples outward into the global market through defense exports. It's all completely connected.
Okay, let's move into our stock tiers, starting with our Tier 1 core compounders. These are the foundational, best risk-adjusted picks we've identified.
Looking at this data, a few names really jump out. Take a look at HAL. It is our top 5 out of 5 aerospace and defense pick, showing a potential 2030 upside of up to 80%. That is huge. Then you've got BHEL, perfectly capturing that crucial defense electronics theme we just talked about, with an impressive 18 to 22% estimated growth. And definitely don't overlook Tata Power here. It occupies a really unique, sweet spot, linking the AI data center boom directly to the massive need for renewable electricity. But honestly, let me focus your attention entirely on L&T for a second. Larsen & Toubro is our #1 overall stock from this entire theme. It earns a flawless 5 out of 5 rating from us. Why? Because it is basically the ultimate Viksit Bharat proxy. It touches almost everything India wants to build right now: infrastructure, defense, power, renewables, heavy engineering, and yep, even data centers. It's just incredibly well positioned to ride this wave. Now, you might have noticed SBI on that Tier 1 list and thought, wait, why is a traditional bank sitting there? Well, this brings us to a really critical concept, the valuation anchor. See, SBI's estimated 12 to 15% growth is definitely lower than the high-flying tech stocks we're about to look at, but its reasonable valuation is absolutely critical. We use it to kind of anchor the whole portfolio against extreme volatility and, introduce some much-needed strict valuation discipline. Let's move to Tier 2 and see how this builds. These are high-growth plays. Now, fair warning, things get way more aggressive here. We're talking explosive potential, but very demanding valuations. Remember, higher returns always mean higher risks. Scanning this Tier 2 matrix, you can see the growth numbers jump immediately. Look at Hindalco. Manufacturing needs raw materials, right? That makes this a fantastic value plus growth combination for critical minerals. Then you've got Mazagon Dock, capturing the naval defense and shipbuilding ambitions. But, and this is a big but, with stocks like Mazagon, you really have to be cautious about re-rating concerns, especially after the massive run-up defense stocks have already had recently. And that brings us to a pretty harsh reality of investing. Stocks like CG Power and Kaynes Technology, They offer massive growth potential. We're talking an explosive 25 to 30% estimated earnings CAGR. But there is a severe valuation risk attached to that. Because they trade at extremely high earnings multiples, there is literally zero room for execution errors. They have to be perfect. Remember, a great company does not always mean a great stock price.
So the crucial point is right here on this chart. Kaynes Technology, CG Power, and Dixon Technologies offer the absolute highest multi-bagger potential from India's electronics and semiconductor story. However, because of their premium pricing and those execution risks, if you were to invest, these are stocks you'd want to accumulate slowly in tranches over time, definitely not in one massive single shot.
Moving right along to our final group, Tier 3. These are our higher-risk picks. This is an interesting mix of turnarounds, optionality plays, and some portfolio stabilizers.
Looking at this final list, the contrast is pretty wild. On one hand, you have the extreme 25 to 30% growth potential of a missile maker like Bharat Dynamics, or BDL. But juxtaposed against that really high beta, you have the lower growth but totally essential stability of utilities like Power Grid and NTPC. Oh, and notice Sun Pharma down there? It's a globally strong pharma leader, for sure, but its current high valuation actually leaves it with a relatively low upside profile compared to the rest of the pack.
Okay, this is it. This is the moment we've been building towards, synthesizing all 15 of these stocks into a unified strategy. Let's build a thematic portfolio.
All right, let's assume a starting capital of 10 lakh rupees. Now, the absolute secret to making this thematic portfolio work is that we are not investing equally across the board. No way. To survive market volatility, you literally must diversify your weightings. You have to avoid becoming overly dependent on the most expensive, highly hyped sectors.
Let's reveal the heavyweights first. Our top 5 core compounders make up a massive 52% of the total allocation. We've got 14% going to L&T, 11% to HAL, and 9% each to BHEL, Tata Power, and SBI. Why? Because this structure provides a rock-solid risk-adjusted foundation. It's built on essential infrastructure, core defense, power, and banking.
So that leaves 48%, which is distributed very strategically as satellite holdings. We get our high-growth electronics exposure through CG Power at 8% and Kaynes and Dixon at 7% each. Hindalco anchors our materials at 6%. NTPC and Power Grid step in as our 5% stabilizers. But pay close attention here. Notice how extremely aggressive, highly valued stocks like BHEL and BDL are kept to tiny 2 to 3% allocations. Actually, Sun Pharma is just 1%. This is exactly how you capture that explosive upside while aggressively protecting the core of your wealth.
And that brings us to our final takeaway. This is where we separate the exciting story from the cold, hard reality.
We really can't end this explainer without addressing the single most critical lesson of all. Consider this timeline. The visions were announced in the policy speech in August 2026. But here's the thing. The market often prices in a spectacular story months or even years before the actual earnings ever arrive. For these stocks to hit their 2030 upside targets, the real earnings growth absolutely must materialize between FY 2027 and FY 2030. If you pay too high a valuation today, your returns by 2030 can still be completely destroyed even if the underlying company actually succeeds. Which leaves us with this ultimate anchor lesson. Don't chase the speech. Buy the earnings beneficiaries of the speech. It's that simple. You must invest based on underlying financial performance and reasonable valuations, not just the political or economic hype surrounding a shiny new sector.
So I'll leave you with this thought. Looking at these interconnected ecosystems, from AI and semiconductors all the way to defense and infrastructure, which one stock from this list do you think has what it takes to become India's next massive multi-bagger? Keep analyzing, keep looking at the data, and most importantly, keep learning. I really hope this explainer gave you a powerful new framework for your own research. See you next time.